Hey guys, how you doing? So Dan from Trading with Dan here. So we're just going to have a quick look at this USO oil fund. So the US oil fund, this ETN exchange traded note. So what this is a fund you can invest in, and the fund then invests in oil contracts, and then you supposedly own something that will track the price of oil. But it's not actually a very good tracker of the price of oil when the market is in contango, and at the moment obviously we're in super contango, extreme contango. So basically what the big problem we've got in this fund is that basically its price has collapsed. So they're doing a reverse stock split, a 1-to-8, so that'll probably put the price around $20 again. I think it's currently about $2 something, $2 something anyway. But anyway, it'll be around the $20 mark. So that is basically to attract retail investors into it. In Robinhood, which is one of the biggest like stock trading platforms, ETF trading platforms in the US, and lots of other broker accounts. The USO fund is being bought up pretty intensely. Not as in bought up as in the price is being bought up, but just the actual contracts are being bought. So what that means is that a lot of retail, especially retail customers, are putting money into it and then are losing that money. But the important thing about what is going on with this contract, and the reason why it can pretty much collapse to actual zero, and shouldn't realistically be even lower than zero, and somebody will be paying a cost basically of it based lower than zero, is that what we've got is a mismatch between the buyers that are buying this through their Robinhood accounts, etc., that are paper traders. They're not positioned in a position to take delivery of the oil that is associated with the contracts that they're buying. So they have to then be rolled over by the USO fund, because the USO fund, again, also, it doesn't have storage itself. It's not in the position or in the business of actually taking on the actual oil contracts. But what we've got going on, and the reason for the mismatch, is that we have got oil producers that are selling contracts basically into this market. So they are going short these contracts, which then these contracts then get included in the USO oil fund, because the USO oil, apparently, it basically equates to about 30% of the open interest in the actual real oil futures market, where actual producers do hedge their actual supply that they have. So the fund is fully exposed to the actual real oil market. So what is going to happen? What they're doing is they are selling these contracts. These contracts, 30% of the open interest is owned by USO, and that can go up when they do this stock split, increase the share count and attract more investors in. So what is going to happen is those sellers, those actual physical producer sellers, are physical sellers of the oil contracts, because they want to deliver the oil at the price they basically sold on the exchange at. So they want to sell that oil. So the buyers, they don't actually want to buy that oil. They want to take a long position in oil and then have that rolled over. But if that can't be rolled over because the physical sellers don't want to buy back their positions in the paper market, they literally want to deliver the oil, and the paper buyers, they are going to have to sell those positions eventually, either for a profit or a loss, but it's pretty much guaranteed to be a loss. But the question will be, how much will that loss be? Because who is going to be the bid in the market if it's only paper buyers and then real physical sellers? So there's going to be none of the people taking the opposite sides of these buyers, i.e. the actual physical sellers, are going to be looking to buy back those positions that they sold short. They don't want to do that. They want to deliver the oil. So the buyers that have bought these positions long, when they come to cash out and have to sell, they are not going to have anybody to sell to. There's going to be no bid in the market. And the reason there'll be no bid in the market, whereas last time we had this towards the expiry of the contract, it went to negative $40 and then came back to just over positive, I think, because there were some buyers that were prepared, and there were a few contracts that did exchange hands there where they were prepared to take the oil on at those prices because there was some storage that they could put it on. So it was still a viable trade. But in about 2 weeks, there is going to be no oil storage at all. No oil storage. So it does not matter how low the price of oil goes on this exchange. You cannot take delivery of that oil and store it anywhere because there is no storage. There is no storage, so you cannot take it. Therefore, if you cannot take it, it doesn't matter how low the price goes. Nobody can put in a bid to buy it because they can't get anywhere there's nowhere for them to put it, basically. So there will be no bid. The market will go no bid, and negative 40 is nothing compared to how low it could do, how negative it can go when there's no bid. I mean, in theory, it can go infinitely no bid. Nobody can buy it. Nobody can take those contracts on if there is no storage and they can't actually take the delivery, because then they're breaking the terms of that contract, and it's null and void, and they won't get the oil. They'll just end up with a fine. So this is the problem that USO's got, because USO doesn't take physical delivery. It has to roll these contracts, and if these contracts that it's buying on behalf of the people that are investing in the fund, if those contracts, which is 30% of the open interest, if those contracts have been sold to them by physical producers, which they are, then those physical producers, they need that oil taken off their hands because they don't have storage, and they're more than happy to take whatever the price they sold at, say $20 odd in the forward month contracts going on into later on this year. So we are definitely looking at a no bid scenario. We're definitely looking at just any price. Name your price. It doesn't matter what it is because you've got nowhere to put it. It's like it's just ridiculous. I don't think I have to give an analogy. You guys can understand that. So that's the problem with USO. It's basically gonna go to zero, and then after zero, after all the investors that have bought it, it's gone to zero and they've lost all their money. In theory, the USO oil fund is going to go negative because to roll those contracts, they're going to have to pay a negative value. So those actual contracts people have bought are going to be worth less than zero. So obviously, these brokers can't exactly phone these people up and chase them up and say, look, you're on the hook for more money, you owe more money. Let's say they bought USO at $20 and it goes to negative 100, which isn't impossible at all. That means they've lost their investment and they're on the hook for another 5 times that amount. So are they going to pay that? No, they're not. So who's going to pay that? The brokers are going to have to pay it. The clearinghouse is going to have to pay it, because those physical contracts sold into the market are sold in the market by real sellers, by real oil sellers, and they basically want to deliver that oil. So someone's going to have to basically take on the loss on those contracts. So this could potentially bust some financial institutions and cause a massive ripple through the financial markets, and could definitely be the next big domino that's going to fall over and hit these markets. So anyway, something to definitely consider there, guys. So remember, trading with Dan, not financial advice. I'm not a financial advisor. Always do your own research, and I'll speak to you soon.